So we're taking a look at the corporation review. It's on the very beginning. It's the very front part of your CHAMPS booklet. And what I'm going to be going through today is just practicing journalizing some of this. So you're going to go ahead. You've got your journal set up. Let's start making some of the transactions. So the following selected transactions are for the Charlie Corporation, which was organized on April 1st. They issued 30,000 shares of common stock that had a $5 par value, and they issued them for $9 a share. And they had 500,000 shares of stock authorized. So get your journal set up. You know that you're going to use 3 accounts. What are they? You know you're getting cash. What else?
Stock.
Okay, and can you just call the account stock? Common stock.
But isn't it,
Paid in capital and excess of our cash, common stock.
Right, so what amounts always go in the stock account? What you paid for, what you issued them for, or what the par value is? Par value. The excess goes in the paid in excess of par. So you're going to, debit your cash, get the par value into the stock account, and then the balance goes into that APIC, additional paid in capital, right? So I've got 270 grand in cash. Okay. I've got $5 par value times 30,000 shares. So I've got 150,000 in my common stock account. And the balance goes in here. When you go down to the next transaction and the preferred stock, we don't need to do another one of those, but what's that going to look like? Yeah, it's going to look exactly the same, except for you've got to call it preferred stock and APIC preferred stock. You always have to do what? You have to keep your stock accounts separate and segregated, right? Only like-kind stocks can be merged. What if you had 2 different classes of common stock, like Class A and Class B? They've got to be separate, or preferred stock 6%, preferred stock 9%. You've got to segregate them. Now, so this is pretty straightforward, right? Let's jump ahead and talk about what a stock register looks like. What is, and this would be on a whole, you'll keep one of these, by the way, for CHAMPS. It's nothing you're going to turn into me. I don't care what your tool is for tracking stuff. I mean, I do care. I don't really care what it looks like. I care that you know how to do it and that it's accurate.
So it's what's authorized issue.
Exactly. And we just did a quick review of this last week. There's 3 terms that describe stock. Authorized stock comes from the company's charter or documents that organize it. And basically it says, how many shares of stock am I allowed to issue? So in this case, I told you they were authorized to issue 500,000 shares, right? The thing about a stock register that's really critical that you remember is all the numbers in here are number of shares, not dollars. So in this example with my common stock, how many shares did I just issue? And right now at this point in time, how many shares are outstanding?
There would be 470.
Now I think that outstanding is always the same except for if you have what? If you've bought back some of your own stock. So issued and outstanding are the same number of shares unless you've bought back some of your own stock. So in this case I haven't, so it's all the same. But let's just play devil's advocate here and let's set up a stock register, and here's what your headings need to look like. You need to have date. I mean, really it's the same over and over. Description, number of shares, and cumulative number of shares. So when you set up your stock register for Champs, this is what it's going to look like. So in this example that we just did, on 4/1, we issued 30,000 shares. So how many shares are out there? 30,000. Now, if I go and I do something next, like I buy back, say 2,000 shares of treasury stock, what's that going to do to my cumulative number of shares? And I should put this, outstanding.
If you buy back.
If I buy 2,000 shares of treasury stock. I'm going out and I've issued it to you guys. I'm going to go buy it back and put it in my treasury. So if I go purchase treasury stock, what did I just say, 5,000 shares? What's out there now? Right? Because I just went and bought them back. So my whole point of this is you need to keep a stock register. Okay, so we went through, go ahead.
Okay, I missed the outstanding part.
Outstanding. How many shares are outstanding? In other words, outstanding means what? How many are still out there? Okay, so number 2, we issue cumulative preferred stock. Help me remember what that is. What's the difference between cumulative and non-cumulative stock? Okay, well, let's just parse this. So the first thing it says is 9% on that preferred stock. What's that? What is that 9%? 9% of what? 9% of par value is how much dividends you pay for 1 share of stock. So what's the par on these things? 20 bucks. So I'm going to pay $1.80 per share, right? In cumulative stock, if I go a year and I don't declare any dividends, what happens the next year when the board declares dividends? If you own cumulative preferred stock,
They have to pay first.
I get all of last year's plus this year's before common shareholders get anything. If it's non-cumulative, it just goes away in years they don't declare dividends. So cumulative preferred stock is obviously gives preferred shareholders accelerated rights. Okay, so go ahead and make the journal entry then for number 2. I issue 10,000 shares of 9% cumulative preferred stock. The preferred stock par is 20 bucks a share. I only issue it for 18 bucks a share. So as always, debit your cash first, credit your stock account for par value, and then plug in your APIC.
APIC, I like that.
APIC, additional paid-in capital. No, but those accounts that in excess, what kind of account is that in excess, that APIC? It's an equity account.
Okay.
So if it's got a balance in it, you can debit it just as well as you can credit it. You can't debit it if there's nothing in it, but if there's something in it, you can go ahead and debit it. Okay? And you would know that.
I thought that was you. Do you know that? No, I was trying to do a swap. That's your option.
Okay, so basically what happens here is you end up having to debit it, don't you? And there's nothing magic about that. The only thing that you have to be concerned with is if you have a balance in that paid-in capital account that can absorb it, right? So I got cash of 180,000. I always do that first. Then I jump ahead and I put the par value in my preferred stock account. Then I start looking at this journal entry and I go, oh my gosh, I need a debit entry to balance it, right? And again, it's a reduction or a contraction of equity, so to speak. I can only do this if there's a balance in that account to absorb it. If there's not, I've got to go to retained earnings. Okay. Next journal entry, I paid an attorney $4,600 for legal fees to organize the company. What kind of account is that? You probably talked about this in about one sentence with Tim in accounting too. It's not an expense. That's exactly what it is. It's not an expense. You don't want it on your P&L because it's some, huh? Yeah, and I don't even care so much what we call it, as long as we don't put the word expense in it. My question is, where do you think the account's going to show up? Where do you want this account to show up? It's an asset. Anything you spend money on that is around setup is an intangible asset, and it's amortized over 180 months on your balance sheet. So it shows up as an intangible asset, right, by your trademarks and your franchises and your patents. And you amortize it over 180 months. You can't take it to the P&L because it benefits more than one period. So when I asked you on this, what's special about this account, or where does the debit go, or whatever it is I said, what kind of account is the debit, the answer is what? It's an intangible asset. Okay, next thing that happens is it looks like I'm buying, you remember this in number 4, I issued 50,000 shares of stock for a piece of land worth 80, a building that's 250, some inventory of 55, and equipment of 1 1/4. That's called a basket purchase. And I'm going and getting a series of assets for some stock. Take a second and figure out what you think you need to do to book this. One more time. Okay.
Well, you're going to credit common stock.
You do? For how much? Par? For how much?
Well, we're issued 5,000 at $5 off.
Yep, so you know what needs to go into the common stock account. You know the amounts that the assets have to go on your books at. Do you think that's magically going to balance? No. So what's going to be your plug account? APIC. Exactly. APIC. So get your assets on the books, get your par value of your common stock dealt with, and then plug it to your APIC. Okay, so basically I debited land 80, building 250, inventory 55, equipment 125. I credited common stock 250, and I credited APIC 260. Okay. Next set of issues, stock subscriptions. This is probably something you haven't seen before. Let me just explain what it is, and then we'll journalize it.
Do we need
Go ahead.
to adjust our common stock issued shares and outstanding?
Oh, good point. Thank you. Yeah, if we're keeping up, absolutely. Thank you, Jess. So the question was, for those of you listening, Jess said, don't we have to keep our register updated? Sure we do. So how many more shares did we issue for our assets?
50,000?
Yeah. And it doesn't look like I've got dates on all this, but. So how many do I have sitting out there now?
80,000.
Why is this number so important to track, and the whole reason we set up a stock register? Like, what kinds of information are you going to use that number for? When you go to declare dividends on a per share basis, how many people am I paying to? What if you're trying to do some of those ratios that we were just doing, like earnings per share or debt to equity? You need to know number of shares of common stock outstanding, right? So this is really important. Or when you do stock splits, right? Your stock splits. So you just need to always keep that updated. Okay, so this next issue with subscriptions is kind of an interesting one. It's where you've got shareholders that want to buy into your company, want to subscribe to stock, but they don't have it's cash right now. So in a way, it's like you're carrying them to get their stock. So let's just take a look at it and see if we can kind of extract some information here. So the Addy Corporation accepted subscriptions, in other words, people saying, I want your stock, but I can't pay you right now, to 20,000 shares of $15 par value common stock at $22 a share. So what's the fair market value of these shares today? I think the fair market value is $22, right? But the par is 15. And what they do tell me is they can give me a down payment of 40% right now. So I'm getting some cash. The balance is going to have to go into some sort of account called what? They're going to pay me later. That's a what? That's a receivable, and it's called stock subscription receivable. That's the name of your new account. Stock subscription receivable. And that's going to show up where? I think it's going to be in your balance sheet. The only other thing that's different is you are going to use an interim account called Common Stock Subscribed in place of where you put the par value until you issue it. Common Stock Subscribed. So how much cash do I get from this subscription? No, how much are they paying me? $15 or $22 a share?
22.
Yeah, 22 a share, and they're giving me 40% of that. And you know the number of shares.
Yeah.
Now, what happens? How much do I still get from the people that are subscribing to my stock? How much do I still have coming?
260.
Yeah. And that account again is called what?
Stock subscription.
Yeah, and that shows up where in my financials? Not on my accounts receivable, but it's a current asset. Now, normally you would go right into your common stock account and put in the amount of what? What always goes in the stock account?
Par value.
Par. But since I haven't, when am I going to actually issue the stock? I'm going to issue the stock when they finish paying me, right? So I'm going to, instead of using a common stock account now because I haven't issued it, I'm going to use like this intermediary account called Common Stock Subscribed. Same thing, par value. Is that going to neatly balance, or am I going to have to plug it? You're going to have to plug it, and you always plug to the same account. And then I want you to tell me what kind of account you think common stock subscribed is. In other words, where is it going to show up? It's not a liability. You say it every time, but I would tell you equity transactions never impact your P&L or your liabilities. It's got a credit balance. How much is in the account? I am having some kind of fun watching you eat those Skittles. You munch down the yellow ones.
I eat them by colors.
We're slightly excited about the reds, and either you're saving or you really don't like the oranges.
No, I like the orange.
Okay.
I must have taken a handful of yellow and found it earlier.
The yellow one was hard.
Mm-hmm. So the amount that goes in the common stock account is the par value. Ten of these things have 150 calories. I'll take 3. Wow. That is extraordinary.
Yeah, and I'll fit me in one of these trying to get through my home. Now we know what my feelings.
What'd you get for the par value?
300.
Oh, I got it.
Okay. And that APIC plugs in 140, right? Now, wow, those are good and they are sweet. The question we're asking is, where does this go? It's a placeholder for the actual common stock when you issue it. So where does common stock go? Goes in your equity section. So where does this thing go? In your equity section. And then when you actually issue the stock, you debit this thing and you credit the common stock account. It's just a placeholder until they pay you off. So the next transaction, go ahead and see if you can make number 2 and 3. The next one, I get half of the money they owe me. And then number 3, I get the other half of the money they owe me, and then I'm going to swap this common stock subscribed out for common stock. So how much did I get in that first batch? 132. So what am I doing? That's my journal entry?
Cash.
Yeah.
That's
Yeah, they're just paying subscriptions, stock subscriptions receivable. They're just paying off the receivable, right? And then when they pay off the other half, I make that again. And then how do I actually issue the stock? What am I debiting?
Common stock subscribe. Oh, when they pay for it.
And what am I crediting?
The receivable.
The first entry says they paid me half. Here's what I do, debit cash, credit receivable. The second entry, they pay me the other half, so I'm saying do this again, debit cash, credit receivable. And then they actually issue the stock, so I got to get rid of this placeholder. So when I was telling you it was a placeholder, that's what I mean. This guy is just sitting in the equity section, like, I haven't issued those shares yet, but when I do, it's not going to impact my equity section. I'm just going to swap these out. So I'm going to pull this account out of my equity section, and this account goes in because now they're issued. And then I go to my stock register. Okay, next journal entry. Treasury stock. So I've got a company named Harrell Corp. They've got common stock, $4 par value, 500,000 shares authorized. Can you figure out how many have been issued by that information? Yay or nay? Okay, how are you going to do that? Yeah, there's $960,000 in the account. We know that's always par value. So you can figure out how many shares are in your beginning balance. So set up a stock register and get that started for this company. Well, let me just, I guess, give you all the instructions. So you're going to need a stock register for the Harrell Company. And the beginning balance you can take from that piece of information. They've got some paid-in capital. They've got some retained earnings. The first thing that happens in this particular series of transactions is I purchase 2,000 shares of treasury stock for $6 a share. So get your stock register set up, and then we'll walk through the journal entries for treasury stock together.
Is what we're doing right now going to impact like our later stuff? Like,
As far as the stock register?
well, no, I thought this was all going to be one business, and then eventually everything we're doing would end up here.
This is just practice. This doesn't have anything to do with champs. I mean, it has everything to do with champs, but this is all practice.
Oh, we're just
Okay,
getting
it's like
warmed
a
up.
practice exercise.
Yes, it's getting us warmed up.
I was just making sure I was keeping track of accounts for my,
We'll do our formal introduction to champs is next Monday.
Yeah, this is just Pilates right now.
This is bar class. I love Pilates. I really like this. This is probably my next favorite to tax and managerial.
you are
Some kind of weird. Does everybody agree we've got 240,000 shares right now? Okay. So let's start on our journal entries. What kind of account is treasury stock?
equity.
Where are you coming with 240,000?
I took the amount that was in the stock account, which was $960, and that's par value, right? So if I divide by the par value per share of stock, I'm going to figure out how many shares are out there. Equity. Equity. I can tell you guys, when there's a journal entry or a transaction impacting equity, the answer is never that it shows up on your P&L. It's never going to be a liability, and treasury stock is a retraction of equity. Okay, so is it an equity account with a credit balance? If it retracts your equity, it's a contra equity account. So what kind of balance does treasury stock have? It's a debit. And the thing about treasury stock is you don't, once I've issued my stock to y'all and then I'm going back to buy it back out of the market as treasury stock, I don't care about par value anymore. The cost basis is what I care about. So how many shares of stock am I reacquiring? 2,000 shares. And how much am I paying for each of them? So what am I going to debit and what am I going to credit?
Debit, treasury stock, and credit cash.
That's it. It's that simple. You are no longer tracking par. The new amount you're tracking is the $6 per share cost basis. Because that's what you paid for it. So when you reissue this stuff, you pull it off the books at that $6. Now go to your stock register and deal with those shares. Get those shares in your stock register. And I'm just making up dates here. And don't forget in the register that you need to make sure to bracket it, because is it adding to your shares or is it retracting them? Yeah. Okay. So does everyone have that down? Now I've got 240,000 shares issued, and how many outstanding? 238. Because once I issue them, they stay issued. Outstanding means how many are out there with y'all. Okay, next transaction. I sold 1,000 of those shares I just bought and put in my treasury for $9 a piece. Why did I do that? I what?
You made $3.
Oh, yeah, I mean, right, okay, the issue is, and so it does, it looks like I'm churning my own stock to make money. If you do, that's actually a breach of the Securities and Exchange Code. So you can't, there's got to be some reason aside from like making money on it, because really then you would be buying and selling your own stock and manipulating markets, right?
Is that a problem?
Yeah, well, it's done all the time, but it's a violation of SEC.
So if they justify it and say they needed the cash,
You have to show what it's for. I needed cash because I'm acquiring something. I had to fund my stock option plan. I had the, blah, blah, blah. But like I was just doing it to, make $3 a share. That's pretty illicit. Okay, but so let's say that I needed the money to acquire a new piece of machinery. Fill this in, and then also, when you make your journal entry up here, stick with me here, how much am I pulling the treasury stock off my books at how much a share?
6.
Yes, this is your new cost basis. Your plug figure is going to go to what?
APICTS.
APIC treasury stock, exactly. It's not going to some like profit account or anything. You technically can't profit on the resale of your own stock. So I got $9,000 in cash, right? How many shares was it again? So $6 a share times 1,000 shares. And the plug figure is APIC treasury stock. Make the next journal entry, fill in your stock register, and then complete these 3 little lines down here, authorized, issued, and outstanding. So make the next journal entry, and then compute the number of shares of the Harrell Company and fill in these little blanks. So when I sold that second batch, what was the challenge? This time I reissued them for less than what I purchased them for. So how much cash did I get? 200 shares, $5 a pop. How much do I have to pull it off my books at? Always the $6, right? Because that was the original purchase price. Yeah. So what's my challenge here? What if I didn't have anything in APIC treasury stock? Retained earnings. Okay, now good. So then the last issue is I asked you to finish this. I purchased another 200 shares, right? So in answer to those questions on the bottom of that first page,
So if you sold those,
what am I doing? Oh, I resold, I see. And I forgot that last one, didn't I?
so you sold.
So I resold, yeah. Resold treasury stock 1,000, we sold treasury stock 200, 238 plus 12, 239 too? Okay, so how many shares do I have authorized?
500,000.
How many shares do I have issued? 240. Issued is always the number that were ever out there. They're issued, they're live, I just have some of them in my own treasury. Outstanding, that's this number, isn't it? So authorized 500, issued 240, outstanding 239.2. If I declared dividends today, which of those numbers would I pay the dividends on? The outstanding. Is this all coming back? Good. Okay, I'm not going to spend a whole ton of time on this. I think you've got like one journal entry in Champs. What is this next page? Appropriation of retained earnings. What the heck does that mean? What is retained earnings? If you were to explain that, this is probably like the most misunderstood account in any company. If you were to explain to somebody that doesn't really know anything about accounting what retained earnings is.
What you have left over after you pay all of your expenses.
So it's a pile of cash somewhere.
That's all your assets.
Yeah, it's net assets, yeah, because assets equals liabilities plus equity. So assets minus liabilities equals equity. But isn't there a lot of other accounts in equity besides retained earnings? Like stock and EPIC? What's retained earnings? Tell me that if I don't know anything about
Well,
it.
assets retained for future investments.
Okay, closer. If you were to tell me, back up to just like accounting one, what's the model for retained earnings?
Oh, it's something about current. It was just current.
What's the model for retained earnings? What do you start with? Anytime you got a balance sheet account, you start with beginning balance plus or minus what? What gets closed into retained earnings?
Your revenue.
That's for for a sole prop. You would have draws in a corporation, so we'll get to that. But what am I going to add or subtract? What closes into it? What's retained earnings? Is there anything in here about cash or assets or expenses? Really what retained earnings is the net income year after year after year minus what you've paid out in dividends. And that's all it is. There's no other explanation. It's what have you, for lack of, I mean, you should never explain a word with a word, but it's the income you've retained in your company that you haven't paid out to your shareholders in the form of dividends. It's not a pile of cash anywhere. Is there cash probably as part of the ending balance somewhere? Sure. So what does that mean to appropriate some of your retained earnings? Basically, all you've been exposed to so far is the board of directors will come usually on a quarterly basis and declare dividends. And you've got to have cash to pay them, and you've got to have enough retained earnings to absorb them. And then you can declare dividends. But they might also say, we want to appropriate a little bit of retained earnings to vertically integrate our business in Guatemala. So we're going to need $2 million in assets and liquidity to go to Guatemala and buy this plant. So we're going to lock up some of retained earnings so it's not available to do other stuff with, like declare dividends. It doesn't mean they're writing a check and putting it somewhere. It just means they're making a formal resolution as a board of directors to lock up a chunk of retained earnings. So when you look at some of these things they're doing that for, they're appropriating retained earnings for treasury stock purposes. They're appropriating retained earnings for contingencies. What's a contingency? Contingency is like, I've got a lawsuit underway and I think I'm going to end up having to pay 15 grand. Or I've got some environmental cleanup down the road or whatever. Appropriation for retained earnings for plant expansion. That's like the moving to Guatemala thing. So basically all it is saying we're locking up a little bit of our retained earnings. All you do for any of these transactions is you're just taking your retained earnings and putting it in a special account called appropriated retained earnings. So what kind of balance does retained earnings normally have? A credit. So I'm just debiting my regular old retained earnings, and I'm setting up an account called appropriated retained earnings for whatever it is. Plant expansion, treasury stock purchase, contingency payment. Does this change your total equity? No, it just changes the composition of it. It doesn't change your equity, it just changes the composition of it. You probably are talking about stuff like this in nonprofit, where they appropriate some of the funds. Oh, okay. I don't know what I'm really talking about.
So, regardless of what it is, contingency or, like you said,
Yep.
you just plug in that.
Just plug those words in here, and that's your account title. It is also an equity account. It shows up right in the equity section of your balance sheet. So oftentimes now, like in your balance sheet, if you've got something like this going on, let's just for giggles, can we recreate what an equity section looks like pretty easily for a corporation? What are the two major sections? This is shareholders.
Common stock.
Okay, capital stock, which has all your different kinds of stock, right? And what else? Retained earnings. And under retained earnings, all I'm saying is now we might have two kinds, regular old unappropriated retained earnings and retained earnings for, whatever, contingency. So if I'm the board of directors, which of these numbers am I looking at to see if I can declare dividends?
Earnings for.
No, the amount that's unappropriated. That's the same as like available, right?
Right.
Do you want to stretch? Oh, well, let's go ahead. Let's go ahead and have a stretch. I need a stretch too. My back hurts.
My cue just all snowed up.
Yeah, me too. And I don't know what I did. I woke up like this. I think I must have slept real goofy. It's so weird. you want to be spraying that on your head?
So bad for you.
Oh, I know, but I'm like running out of options of stuff that'll make my hair like a normal size when it rains.
Normal size. Yeah, I quit shampooing my hair every day. Oh my
That's what my husband says in the summer. He comes up to the lake and he goes, so when's the last time you showered? I'm like, what day is it? I just because I just don't care. It's the summer.
Or
I'm
you
in and
jump
out of
in
the
the
water.
lake, right?
I'm on the boat. I'm, riding my bike with a helmet on. Who cares? And he's like, it's time. I'm like, okay, thanks.
Aw, that's love, though.
It's time, hon. I'm like, okay.
Well, I like use conditioner in my hair every day, but I don't shampoo it every day.
Oh, interesting.
Yeah,
It keeps it from getting
it keeps
super
the
dry.
afro down.
Yeah,
But I should have shampooed it so that I
I started doing the same thing.
Oh, my kid had it said that fever, and she called in my bed. And I
Aw,
woke up just
poor
dying.
thing.
She ended up with strep throat. Yesterday was a huge day because check this out.
Oh, is she precious? She lost her first tooth, Mom.
Yeah, I could, the tooth fairy gave her a $2 bill.
How cute.
She took it for her show and tell today.
I love there's still tooth fairies. Okay, let's finish up this and then we'll keep moving.
You sure, Carrie?
So, what do you think you need in the capital stock section? Really, you've got your two kinds of stock, or maybe more. Then you've got all your APICs. How come I've got APIC treasury stock in here, but not the treasury stock itself?
This treasury stock is our retained earnings.
Treasury stock's a contra stockholders equity account. It's down here, isn't it? It doesn't add to my equity. It does what? Subtracts from it. So that's kind of a little weirdo with that. The other thing that I want you to be aware of to do in a good form financial statement, and that's really what the kind of the culmination of the whole CHAMPS project is. And really, basically, at the end of the day, you're going to do all this work, and all you're going to turn me in are the financial statements. But when you do those, in here, you've got to tell me a number of things about common stock, 4 things, and preferred stock, I need 6 things. What's one thing you want to know about common stock? I guess I'll just tell you.
The car down.
Yeah, you want the par on both of these, right?
Sure.
Yeah. So that same thing we just did: number authorized, number issued, number outstanding. Number authorized, number issued, number outstanding. Also on preferred stock, I want you to tell me that dividend rate, right, the percent. 6%, 2%, 8%. And then, no.
You know how many pictures I have of you?
Oh, God.
No.
Scary. What was it? Say par, fixed dividend rate. Oh, and then you've got to tell me, is it cumulative or non-cumulative? So that's a lot of stuff to put all in the balance sheet, isn't it? But that should be on the actual equity section of the balance sheet. Okay. Dividends. The Henderson Fertilizer Company's balance sheet at November 1st, 2010 showed the following balances in stockholders' equity. Common stock, $7 par, $700,000. Paid in capital, that's funny. Paid in capital, common stock, $280. and retained earnings 590. And the board of directors, so this was December 1st, 2010. The board of directors declared a cash dividend of 30 cents per share to stockholders of record November 15th, payable on the 30th of November. Make journal entries for the 3 following dates. So first off, you need to make the journal entry on the 1st of November to actually record. That's the declaration date. Then on the 15th is they run the stock register. That's called the date of record, right? They run the stock register and they determine who's going to get the dividends. Because between the time when they declare the dividend and the day that they actually send the dividends out, lots of shares can change hands, can't they? Is there an entry on the date of record when they run the stock register?
There is, but I can't remember what it is.
That's just the day they run the register. No journal entry. This day, they may have had a liability, and then on the day that they send it out, they actually have paid the cash. So see if you can figure out what to do on the declaration date for a journal entry on 11/1, and what to do on the payment date on 11/30. Do you put it into retained earnings or take it out of?
Well, I
Right.
imagine putting it on the table.
Okay, great, perfect. So at what date is retained earnings officially impaired?
No, when you
On the
declare it.
30th when you pay.
No, it's when they declare it. That's a legally binding contract.
Earnings, then.
Yes.
Okay. I'll move to.
And then it's the second credit when they pay it out, does that go to cash or does that go to retained earnings also?
Do you want to double dip in retained earnings?
So it's cash.
Yeah.
You're paying it.
Oh, wait, so am I paying any cash here?
No.
So what kind of account do I have to credit?
Payable.
Yeah, you got to put it in a payable. It's just regular old current liability account. What do we want to call it?
Dividend.
Yeah, nothing fancy. I do believe in chance that they have 2 accounts, one for dividends payable common stock and dividends payable preferred stock. But make sure that you understand whenever you see this word, it's going where in your financials.
Liability.
And now you can answer liability. So when we go to pay it off, what do we have to do? Or not pay it off, actually send the dividend checks out.
Debit the payable.
Yeah.
The payable
That's it. Yeah.
Something I noticed too, going through all of these accounts, we have like 9%, or wait, we have like a 10% I'm just like making that note that there's different stuff.
Oh, gotcha. You mean preferred stock dividend rates?
Yeah, right here.
Okay, so the next page gets a little trickier. Now what happens on February 1st for Henderson Company?
Yeah, but stock dividend.
What the heck? On February 1st, 2010, the Henderson Fertilizer Company declared a 10% stock dividend payable on Feb 21. Market price of the stock on Feb 1 was $12.
So you just issue them stock?
I'm on the next page,
Well, I thought I was too.
aren't you?
No, it's number 2 on the bottom.
Oh, I turned the page. You didn't have to turn the page. Okay, sorry.
So they're giving them stock instead of money.
Right. Why does a company do that? Why does a company give them stock?
They don't know if they give them cash.
Yeah, I want to give you something of value, but I don't have cash, right? I don't want to give you cash. Or like if you're one of these hot startup little companies, you're the Tinder or the Slacker or the Uber or the Lyft or all these companies I read about. I get this Fast Company, which is all the startups, tech companies in San Francisco. And I don't want cash. I want their stock because I think they're going to go through the roof, right? I don't have a stomach to invest in this kind of stuff, but if I did, that's what I'd want. Now,
Doesn't it kind of stimulate the market a little bit?
oh, sure. It makes everything hot, the stock, it makes the stock hot. Okay, 10% of what? When it says I'm issuing a 10% stock dividend, 10% of what?
Out of how many shares you want?
Yes, ma'am. Number of shares, what? Issued, authorized, or outstanding?
Outstanding.
Yep. So you've got to figure out how many shares these guys have outstanding and find me the number of shares of stock they're planning on issuing for the dividend. How many shares are they planning on issuing for their dividend? How many shares are out there right now?
100,000.
Did you get that off the balance sheet?
Maybe or balance sheet.
Oh yeah, 100,000. 700,000 is in the account, $7 par. There's 100,000 shares. They're issuing 10% of that. So how many shares are they issuing? 10,000 times 0.1, or 100,000 times 0.1.
10,000.
Yep. Now, here's the scoop. These are the number of shares they're issuing. You're going to debit or impair retained earnings for the fair market value. So how much am I debiting retained earnings for?
Well, it looks like it was 12 bucks.
120.
120,000. Am I actually issuing the stock today?
No,
No, you're just.
No, I'm declaring it. So it's just like that dividends payable thing. But think about this before you answer. This is an equity transaction, right? Is any cash trading hands? So am I setting this up as a liability? I'm doing that little placeholder thing like I did with common stock subscribed, but I'm going to call it common stock dividends distributable. And I'm going to give you a hint. This is the amount that's going to be replaced by the actual common stock when I send it to my shareholders. So what amount does that have to be at? That's going to swap. It's got to be at par because when I actually send the shares out, and then what's the plug figure going to be to? Yeah. So finish this transaction off. and then go to the next one and actually issue the shares.
Wouldn't you just use the credits and then have debits and credit cards?
Yeah, all you're doing, okay, let's finish this. So what's the, yeah, no, not cash. There's no cash trading. What's the par value?
$70,000.
Okay, so APIC's
50,000.
50. Okay, great. So then when I go to actually, then there's a data record, right, where I run the stock register and get everybody that's going to get them. No entry. Then the day that I distribute them, all I'm doing is pulling the same thing with that as with that subscribed stock. I'm pulling that placeholder account out of here, and I'm actually sending them the common stock. No big. This is just a placeholder, as if to say, because you're always worried, or not worried, but you want to make sure you don't go over the number of shares authorized, right? So once they've declared these things, or once somebody's subscribed to them, even though you haven't actually physically issued them, you've got to be cognizant of it. Okay. Let's finish up these last couple ones, and then we'll color good. Okay, I'm sorry, I've got the bad dates up here. That was March 4th, right? And then this was April 1st. Okay, now, here's your challenge, you guys. On the 24th, I declared a 40-cent per share dividend. You've got to make a stock register because you don't know how many shares you're declaring the dividend on. So April 24th, declared a 40 cents per share cash dividend payable on May 3rd, and then I paid it.
Weird.
You need to,
Weird. I think part of your stuff got cut off, Lisa, because you.
oh no, I'm jumping ahead. My bad. Okay, so we're done with this. We're done with Henderson. Okay, now we're on this last, which is the last section, cash dividend, and stock split. Hint, do a stock register. So why don't you guys all go ahead and get your stock register set up, and we're only doing a stock register for the common stock. So we're on the Stelcheck Corp on March 1st, right? So set up your stock register, and then we'll all catch up on March 4th, where we, sorry to those online, that was probably confusing. This one that we just did, finished up Henderson Fertilizer. And now the last thing we're going to do today is the Stelcheck Corp. So get your stock register set up. I'll get mine set up, and then we'll start doing the journal entries. Yeah.
And all this practice stuff, are we ending?
No.
Okay.
I'm starting with 420,000 shares, right? On March 4th, I declared a 10% stock dividend on the stock outstanding. The market value of the stock is $14 on the day that I declared the stock dividend.
Don't we record the building authorized?
There's nothing, authorized just means you formed a charter and that's how many shares in total you can issue. So that's already on the books when I go into this year. So the first journal entry you're going to make is the stock dividend declaration on March 4th. So how many shares am I going to send out for the stock dividend? Yeah. Right. So make sure that you get the right math for your debit. Par value goes into your credit. APIC is your plug. So I got 588. What account am I debiting again? Yeah. And do I go straight to the common stock account? It's not a payable, it's an equity account, right?
Isn't that the common stock dividends?
Yes, it's not a payable, it's not a liability. You've impaired equity. That's different. You don't owe any assets. And that, okay, is that right? That 400?
I got 420.
What's the par value again?
10.
Oh, okay, so it's 420, yeah.
Then AGIC CS for
Okay, go enter the stock dividend in your stock register. I'm sorry, make your April 1st journal entry and then go issue your stock in your stock register. April 1st, I'm getting that placeholder account off my books. And I'm actually issuing stock. That journal entry does nothing to my equity, that my total equity, it's just I turn the placeholder into the real thing. And now I gotta go enter those shares in my what? Yeah, you gotta put it in your stock register now.
Didn't we already do that?
I think we got the beginning balance in there. I haven't gotten my dividends, my new stock in there yet. That didn't happen until, do I enter that on 3-4 or 4-1? Yeah, I think 4-1. And my description is 10% stock dividend. Another 42,000 shares. So 462, right? Then I declared a 40-cent per share cash dividend on April 24th, and I paid it. Can you make those two entries? I declared a 40-cent per share cash dividend, and then I paid it. How many shares do I have out there now? 462?
Yeah.
All right, so now I owe them 176 grand. 40 cents a share, 462,000.
I got 184.8.
That's what I got too.
I don't know why my numbers are off on this one. 184.8.
Yeah.
Okay, then what happens when I pay it?
Yeah, dividend as well.
Yep, that's it. Does this impact your stock register at all? No? Okay, what happens next? The board of directors authorizes a stock split for 2-for-1 with a reduction in par value to $5 a share. Why do I do a stock split?
Bring the price per share down.
Yeah, it's when stock gets so hot that it's trading for a couple $100 a share. Nobody's buying it because it's too much. It doesn't change anything other than the composition of the number of shares. What does it do in my stock register? Right, so how are we going to enter that?
We're going to put stock split 840.
Yeah. So let's go ahead and get that in the register if I can find it. What date do I do that on?
Third May 1st.
May 3rd, okay.
Or no, sorry, November 1st.
November 1st. 2 description, 2 for 1 split. So how many more shares am I essentially putting out there?
Additional 460.
Yeah, sure. So now there's 934? 834. 934. No.
924.
I used to be such a whiz doing math in my head. I think it was an indication of something, and that's starting to fail. Do I have a journal entry for stock splits? Not really. There's nothing to journalize. Last transaction, declared a stock or a cash dividend of 25 cents per share, and then I paid it. Make those 2 journal entries, and we'll call it a day. How much is it?
231.
Could we have done any of this without a stock register?
Having this info.
Yeah.
Oh,
Because you don't know how many shares you're paying on. And if you'd miss something like the split or the stock dividend, it'd be very easy to get these calculations wrong. Okay, for Wednesday, I would heartily advise you to look at 2 things in your accounting 2 book. One, you should look at bonds payable. We're going to do premiums and discounted bonds. And secondly, you should take a look at your statement of cash flows.
We're actually doing that.
Okay, cool. Okay, good. I bet you that's way different than profit. Okay, so great job. And we will see you on Wednesday. No assignment other than to really look at your discounts.
No internship stuff?
Your internship stuff needs to all be in by Wednesday.
Well, I thought we had.
Oh, we're going to internship now. Yeah.
He's on a different road.
No. Is it? No. No.
Then this one we're in right now? Yeah. Then the one we